This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. I'm John Budden, and welcome to Money Talk on this incredible Canada Day weekend. We start today's show with Dave Sally of the Ottawa Business Journal. Then we go on to Matt Hendricks, who is Senior Vice President of National Sales at Sprott Asset Management. Then to David Rosenberg, Chief Economist and Strategist at Gluskin Sheff and Associates, and he joins our affiliate BNN to provide his perspective on the possibility of a Bank of Canada rate hike in July. After the news, we go to Gus Papagiorgio, Associate Director of Research at Macquarie. He tells our affiliate BNN that there's still some room left for Shopify to run, despite it sitting at the top spot among TSX performers. And he's in conversation with Michael Hainsworth. Then to Paul Bagnall of our affiliate BNN and the Home Capital Annual General Meeting in Toronto on Thursday. Home Capital executives talked to shareholders about Warren Buffett and plans for a new CEO, the dividend, and more. After the final break, we go to Patty Lovett-Reid, CTV's chief financial commentator. She discusses a new Mercer report measuring the solvency of Canadian pensions. And then we conclude today's show with your personal investor and Dale Jackson on why Canada is one of the best places for retirement savers. But first, let's go to Dave Sally at the Ottawa Business Journal. It's great to be joined by Dave Sally of the Ottawa Business Journal on this holiday weekend. Dave, the organization that owns the Ottawa Red Blacks reported last week that the team's 2016 Grey Cup victory came with a price, while a Canada-based telecom firm that was pulled back from the brink of bankruptcy announced it has been sold to a software company.
That's right, John. Well, let's start with the latest financial report from the Ottawa Sports and Entertainment Group. That's the consortium of well-known local entrepreneurs that owns the CFL's Red Blacks, as well as the United Soccer League's Fury and the Ontario Hockey League's 67s. It is also the private arm of the city's Lansdowne Partnership, and last week it disclosed its annual earnings in a report to the city's Finance and Economic Development Committee. In the report, OSEG says its revenues for fiscal 2016 rose 17% to $50 million. That increase was attributed largely to more tenants in the retail shops at Lansdowne. The report said about 3.4 million people visited Lansdowne in 2016, a 41% jump over the previous year. That influx came thanks to events such as the Brier, the Panda football game between Carleton and the University of Ottawa, and a championship Red Blacks team that sold out every home game at TD Place. But the report also says that success came with a price. OSEG says it actually posted a net loss of $14.4 million in fiscal 2016. That's up from a loss of $12.6 million a year earlier. OSEG said the bigger loss was partly the result of paying a year's worth of interest on its retail loan. But it also said that, quote, winning the Grey Cup proved to be expensive, unquote. The organization didn't elaborate on that statement in the report, but is expected to give more details at the next FEDCO meeting on July 4th. The report says OSEG's operating results have improved overall, but that expected profits are still falling short of its goals. The report says the 2017 Grey Cup and the NHL Winter Classic between the Senators and the Montreal Canadiens will attract more tourists to Lansdowne later in the year. OSEG believes the Grey Cup game and festival will bring 200,000 visitors to the park, resulting in $100 million in economic benefit for the city.
And Dave, an Ottawa telecom firm that has struggled financially for years has been sold to another Canadian software company.
That's right, John. Canada-based Magor has been acquired by Harris Computer Systems in a deal worth $2.75 million. Magor makes video conferencing software solutions. The firm's future has been up in the air for months. The company had been posting regular losses and suffering declining revenues for over a year, and was surviving largely on funding from local tech icon and Magor chairman Terry Matthews and his companies. Last September, Magor announced it would undergo a strategic review to look at ways of turning around the ailing company. Former Chief Executive Mike Pascoe also left the company last year and has since joined consulting firm Stratford Managers. Chief Financial Officer Brian Baker replaced Mr. Pascoe as interim president and CEO. In November, the company filed for bankruptcy protection and delisting from the TSX Venture Exchange. Magor's shares stopped trading in November, and the company provided no further update for the next 6 months. According to its last public filings, Magor's long-term debt stood at $3.6 million as of last July 31st. The acquisition price will go towards paying off creditors, with the highest percentage investors being paid off first. Representatives from Magor, Harris, and Harris's parent company had no comment on the acquisition.
And Dave, what's on the OBJ's radar for this week?
Well, John, when it comes to name recognition, few of Justin Trudeau's cabinet ministers can compete with the man who holds the transport portfolio. That would be former astronaut Marc Garneau, the first Canadian in space and the former head of the Canadian Space Agency. Tuesday morning, he'll be the guest of the Ottawa Chamber of Commerce, the West Ottawa Board of Trade, and the Orleans Chamber of Commerce for a national affairs luncheon at the Shaw Centre. Mr. Garneau will speak on the future of trade corridors in Canada and offer context to the federal government's $10.1 billion investment in trade and transportation projects. For more information, go to ottawachamber.ca.
Enjoy the rest of the weekend. We'll talk next Sunday at 2 p.m. Thanks for joining us.
All right. Thanks, John.
And now to my weekly chat with Matt Hendricks. Hi, Matt. I hope you're having a good holiday weekend.
Well, I am, John. Up at a friend's cottage, enjoying it with the family and trying to stay out of the rain, but it's pretty tough.
This past week, we had Mark Wisniewski, who's a senior portfolio manager at Sprott Asset Management and Fixed Income in Ottawa, and I was wondering if you could just summarize for our listeners his visit.
Yeah, John. So Mark Wisniewski came over to Sprott about 2 years ago, and he used to run over $1.5 billion for high net worth money in his strategy, which we call a corporate bond overlay strategy. So I think, as anybody in the financial world knows, traditional fixed income is dead. I mean, we're at the end of a 35-year bull run. Interest rates are still on the ground. The risk-free rate, GICs and such, are paying literally nothing. So you really have to think outside of the box about how are you going to get yield without going way up the duration ladder. And Wisniewski's strategy is perfect for this. So he buys a handful of investment-grade bonds, some senior secured loans, some preferred shares, and then he overlays that by taking interest rate out of the mix by going long investment-grade and short governments. And therefore, the yield in his portfolio is close to 7%, while his duration is less than 2.5%. And John, you and I have talked a lot of times about these big, bloated Canadian bond funds, over $300 billion in these things, where it's the other way around. The duration is 7 or 8, and the yield is 1.5. So there's so much trouble waiting in these bloated bond funds, and guys like Wisniewski are providing our high net worth clients with a great yield and very, very low risk.
Now, what was the story in the New York Times today?
Basically, they were just talking about how the central bank's trying to mess with the short-term rates, but the long-term rates are actually declining. So the market is not believing what the central bankers are telling them. And so basically this article is just saying that this is turning into what could be signals that a major storm is coming, not only in the bond market, but in the stock market. And it's advising its readers to definitely shore up their portfolio and be ready for some sort of event. And John, you and I talk about this every week about how you need to have a diversified portfolio with defense built in on the equity and on the fixed income side. And I think many times we've let our listeners know that at Sprott we have all of that covered. So we'd be more than happy to talk to clients, listeners, or brokers about what we do at Sprott and how we achieve that mix.
And how do they talk to you, Matt?
Well, John, always available toll-free at 866-299-9906. And we've got a great website, sprott.com, where you can actually click on Mark Wisniewski's link. There's about a 6-minute video. It explains pretty simply what he does and the numbers that he's provided for clients over the last 8 years. It's just been fantastic. And again, at Sprott, we do things differently. We are alternative. And as this world keeps moving, you're going to need to find more and more products that don't just hug an index and actually add value and replicate things that you can't replicate through ETFs. And that's what we're doing here at Sprott.
That's a great update. And enjoy the rest of the weekend, and we'll talk again next Sunday.
You bet, John. Thank you very much. And happy Canada Day to all of our listeners.
We'll go to a break, and when we come back, David Rosenberg, chief economist and strategist at Gluskin Sheff and Associates, and he's going to take a look at the possibility of a Bank of Canada interest rate hike. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
I want to take you to the TSX Broadcast Center now. David Rosenberg is the chief economist and strategist at Gluskin Sheff and Associates. That's where we find him now. David, good to have you with us again.
Thanks.
Where are you? July, yes or no?
Well, let's say at this stage a very tough call. They can move in July right now based on everything that they've told us in the past week, and it wouldn't surprise me in the least. But you're going to ask me, is it a done deal that I'm going to tell you here and now that, oh yeah, definitively July? I'd say that by the end of the summer, I think by September, October, they're probably going to go unless things collapse in the economy or some exogenous shock throws them off. I would not surprise if they go in July. It's not my call. I think they'll go by the end of the summer, but if they were to go in July, I wouldn't exactly fall off my chair.
We've been told we've got the best jobs growth since 2012. GDP is rising at a clip we haven't seen since 2010 or so. Between now and the July 12th interest rate call, is there an economic data point that you think could derail expectations of a rate increase?
I don't think that there's a specific piece of data. I think that, look at if the oil price, for whatever reason, were to, say, go back below $40 a barrel, or say that there was some global seize up in financial markets, then that could be the sort of developments that would push the Bank of Canada onto the sidelines through the summer if that were to happen. I don't think it's necessarily one particular data point. A lot of people were saying after last Friday that, with inflation plunging and across the board, all these price measures the Bank of Canada pays attention to, the view is that, well, certainly they can't raise interest rates with the inflation numbers falling, and if anything in the past couple of days, the bank has stepped up its rhetoric that they're going to move. Doesn't mean they move in July, but they're going to move sometime, say, in the summer. So I don't think it comes down to one particular data point. I think that if they get thrown off guard, it's going to be something that happens more in the financial markets or the commodity markets than, say, is any particular data point at this stage. As
far as data points go, you point out the inflation figure in this country. It's quite tame as far as the Bank of Canada's ban for inflation pain is concerned. Is that the primary reason why you don't think it's necessarily a screaming, yes, we're going to see rates rise July 12th?
Well, I think that it's that alongside, I would say that still some uncertainty over the, I would say, the veracity of the economic data. The question is how much fragility is there underneath the surface. But I would say this much, that the Bank of Canada should raise interest rates. I don't know if July is really baked in the cake. The markets are not telling you it's 100% of a done deal. You think that, if that's the Bank of Canada wants to pull a surprise for the markets, they'd want to continue to have, investors getting towards that particular time frame. To me, if you're a trader, it's important to get the month right. But if you get the general direction, the Bank of Canada probably starting in the summer, that could be July, could be September. I wouldn't be surprised if they take back those 2 emergency rate cuts they engineered back in 2015, strictly because the emergency isn't there anymore. And I would say that, I wasn't saying this was me. There was some market pundits were saying, well, these inflation numbers on Friday were so microscopic that why should the Bank of Canada have to raise interest rates, considering that, well, after all, price stability is their mandate. But really what's unusual in Canada is that even with, say, a 1.3% inflation rate, which admittedly is very low, and you could argue below the Bank of Canada's de facto target, the overnight rate is 0.5. So even with these low inflation numbers, real interest rates in Canada are negative at a time when real economic growth is, say, roughly 2.5%. And that's not usually a tonic that's going to be sustained for any length of time. So my guess is that the Bank of Canada raises interest rates. They've already signaled that. Getting the exact timing right is actually a bit of a mug's game. I'm not convinced it's going to be July, but there's a good chance that it will be.
That signaling has lifted the loonie to a level we haven't seen since Valentine's Day. Does the love continue for the Canadian dollar? Where does it peak out at?
Well, if it gets, say, into a, we're almost there. I was going to say a 78 to 80 cent range. I think that it's I was very bullish. We're in the low 70s. We get to the high 70s, I become a lot more neutral. These currency markets, much like any particular asset class, whether it's equities or whether it's bonds or commodities, currencies also could often overshoot or undershoot their, say, intrinsic value. Like we did back in early 2016, when to sustain the Canadian dollar below 70 cents, you had to basically get the oil price down to, say, $20 a barrel. Well, we didn't get to $20 a barrel, and the Canadian dollar bounced off that 68 cent level. It undershot to the downside. Nothing says that you can't overshoot to the upside and break above 80 cents. If that happens, actually, I probably will turn bearish on the currency. But does it have at least, at this stage, 2 or 3 cents upside if we're sort of chasing pennies in front of the steamroller? Yeah, it probably has more upside right now, but we're getting towards the tail end of this counter-trend rally in the loonie from my lens in any event.
So then what is the intrinsic value of the Canadian dollar as you see it?
About that, I would say that 78 to 80 cents is, quotes, where it should be based on growth, based on interest rate differential, based on commodity prices. So we're almost there. Not there yet, almost there. We break above that, and, I will more gladly turn bearish on the currency. But right now I think that 80% of this up move in the Canadian dollar from the recent lows is behind us. That means we have probably another 20% of an up move left, which is another few pennies. And so, at that point, I think we're fair value, and I would turn neutral. When that happens, who knows? The way it's going, it could happen by next week. But we're getting much closer to fair value on the loonie.
I wonder if the acceleration continues. Well, I can imagine it would if, as some are predicting, that July is not the only interest rate increase the Bank of Canada does. Are you in a one-and-done sort of frame of mind, or do you think that we could see a July and then in October and then possibly a December?
Well, I don't think they're going to go crazy, and raise like 4 or 5 times. I think stage one. No, I don't think they're one and done either. I said before. Remember, they implemented 2 emergency rate cuts to guard against a recession. That's well in the rearview mirror. So I think that they will take back those 2 rate cuts of 2015. Will they do more than that? It's to me that's actually debatable. If you're very bullish on global growth, you're very bullish on the U.S. If you think the Fed's going to continue to raise interest rates, well, then the bank might be caught in a box. But actually, I think the U.S. economy is actually on soft ground. We haven't seen the full impact of the 4 rate hikes the Fed's implemented into the real economy. And the dot plots in the Fed are only telling you that they really only have one more in their chamber for the balance of the year. So for the bank to go more than twice, no, I highly doubt that.
What do you think this means for the housing markets of Toronto and Vancouver if they take back those 2 emergency cuts, as you point out?
Well, in the markets, actually, like everything else in life, everything is at the margin. So it's going to, alongside, especially in these 2 markets, which are very overvalued, alongside the other measures taken to tax foreign investors, going 50 basis points, say, is going to have an impact. It's not going to cause a crash, but it's certainly going to have an impact on a market in Toronto that is already cooling off. I don't think it's going to be enough to burst the bubble, no. But will it be enough to cause a further reversal in what was a bubble condition in GTA residential real estate? Of that, there's very little doubt.
Is Toronto cooling off because of those 16 measures the province brought in, or was it already cooling off before Queen's Park stepped in?
I think that these the measures they brought in from Queen's Park are having an impact, and there's no doubt about it. You could see it. Speak to any real estate person in the area, and they'll tell you that that they've noticed a cooling off, and you're starting to see it in the data. Why would that be a surprise to anybody? When they did this in Vancouver, 18 months ago, you had for a period of about 9 to 12 months a significant cooling off in housing activity, in prices and sales in the Vancouver area. The bubble didn't pop, by the way, but things cooled off measurably for about a year. And of course, very recently, they picked right back up again. So I would anticipate, why would it be different in Toronto than it would be in Vancouver? I think that regardless of what the Bank Canada does, which probably raises rates a couple of times. That'll have some moderate impact. I think that you're going to find the complexion of the real estate market in the Greater Toronto Area is going to be a lot different in the next year than it was in the past couple of years, no matter what the Bank of Canada does. So, I think things are going to be quite cool for at least the next several quarters. Be a good news for potential buyers.
Indeed. Thank you, David, for your time.
You too.
David Rosenberg, Chief Economist and Strategist at Gluskin Sheff, joining us from the TSX Broadcast Center.
We'll go to the news, and when we return, Gus Papagiorgio, who is Associate Director of Research at Macquarie, and he's going to talk about Ottawa-based Shopify. Stay with us, folks. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
A number of high-profile Canadian retailers have come under sustained pressure this year. Sears Canada entering creditor protection amid a more than 15% swoon in revenue. Hudson's Bay under fire from an activist investor claiming the company's real estate is worth more than its retail. It's nothing new for retail observers south of the border who have seen a steady erosion of brick-and-mortar retailing in recent years due to the influence of Amazon and broadly changing consumer habits. And yet, as many retailers continue to keep up in both the U.S. and Canada, TSX-listed e-commerce player Shopify continues to grow its offering for anyone who wants to build an online store. Top-rated analyst Gus Papagiorgio with Macquarie tells me the momentum is sustainable.
Well, I mean, the stock has done very well this year. I think it's given up a little bit of its gains the last little while. I mean, look, I think the business momentum is absolutely sustainable. I think these guys will continue to grow at very high rates for years to come. But the stock is expensive. I mean, it hit $100 US, and it was trading at that time 14 times EV to sales, which is a crazy multiple. Since the pullback, it's come down around 10 times, which is still a big multiple. I think it's probably range-bound here until the next results, but I think in the next results you'll see that they continue to deliver great numbers. So I expect the stock will continue to rally over the next few years.
What's the investment thesis that has some willing to pay more for it than what the underlying fundamentals suggest?
Growth. Right. I mean, it's very hard to find companies that are growing 75% a year over year. And it's not just the growth. They have this phenomenal competitive position. They've completely blown away their kind of private competitors like BigCommerce and Volusion. Amazon is out of the game. Facebook really isn't a challenge. So they have roughly 430,000 customers, and the total addressable market is 10 million, and it looks like they've got it pretty much to themselves. So I think that's what people see, and that's why they're willing to pay up.
Okay, so when somebody as a client of Shopify specifically decides that they want to get in on this action, they're providing an e-commerce solution, as it were, to their potential customers. But there's an incredible amount of data that gets transferred back and forth. Shopify gets to keep all that data?
Yes, they get to keep all the data, but what they're doing with it is that they're actually delivering it to their merchant customers to help them become more successful. So they say, if you're selling leather goods, for example, there are, 2 or 3 themes that seem to work best for that market, and there's 3 or 4 apps that you can buy in the Shopify store that seem to really help sales. So, if you use one of these 3 themes and these 5 apps, your odds of success increase by 89%. And so this is a phenomenal occurrence, because up till now, big companies like Canadian Tire or Walmart had the money and the technology to use their data to help them improve their businesses, but a guy in his basement selling leather goods didn't. But now they have enterprise-level intelligence right down to the small to medium business person.
Let's look from the investment perspective. I was talking to Canada Goose this past week, asking them about that dual-class share structure. People are very opposed to that sort of thing, but it's also the kind of thing that Shopify has,
yes. And
it doesn't sound like that's the kind of thing that's going away anytime soon.
No, it's not going away anytime soon. I think people are okay with it as long as the stock continues to perform. Shopify stock has continued to perform, and Tobias, who holds most of the Class B shares, has done a phenomenal job at growing this company. I think his interests are aligned with those of shareholders. So I know people don't like it, but I think in this case it hasn't been a sore point to most investors.
Right. So it's once they stumble, that's when we start thinking about corporate governance.
Then it's an issue.
Then it becomes an issue. When it comes to the bigger trends within the industry or so, how do retailers compete against your Amazon.coms? In this past quarter, we had Amazon buy Whole Foods, and we're like, no, now the grocery industry's all been upended.
I don't think they're necessarily competing against Amazon. I mean, I think the way I view it is Amazon is a big internet mall, and Shopify is a way for you to open up a store within that mall. So I think the issue is that, retail follows foot traffic, and foot traffic is increasingly on the internet. So I think the challenge for retailers is that the physical presence is dying and the e-commerce distribution is growing.
So you're not worried about Amazon basically doing a Shopify-like plug-in for a website and eating their lunch overnight?
No. Amazon was in this game. They had an offering called web stores, and they shut it down about 2 years ago, and they migrated their web store clients to Shopify's platform. I think there's a lot of things wrong with it. I don't think Amazon really understands a small to medium business person. But in addition, if you look at what Shopify is doing, anybody that opens up a Shopify store can sell their products through Amazon. So, for Amazon, that's great because Shopify is enabling all these small, medium business people to get on the internet and to sell through Amazon. So the platforms aren't in contention, right? They're mutually accommodating platforms. They're helping each other out. So I don't see why Amazon would see Shopify as anything else but helpful to their platform.
Well, further to the Amazon angle with the Whole Foods buying physical store locations, that concept of bricks and clicks seems to be picking up. Does that help a Shopify?
I don't know if it necessarily helps Shopify. I think what Shopify can do for retailers is if you decide that you want a physical presence, or even a temporary physical presence like a pop-up store, the Shopify has a point of sales software that can help you operate that physical presence. And then so what that gives to retailers is you have omni-channel distribution, so on the internet, through Amazon, so through your own website, through Amazon, through Facebook, through brick and mortar stores, and you have one view of what's going on in the background, so you can see all your sales through all the different channels, all your inventory levels. So I think that Shopify can help them go from the the internet presence to the physical presence.
When we were talking with Shopify, they were pointing out that Donald Trump's rhetoric is certainly helping them attract big brains to the Canadian operations. Do you think there's a way to quantify that?
No, I don't think. No, there's no way to quantify it. It's definitely helpful. I mean, I think the company's success speaks for itself, and I think they can hire pretty much anybody they want.
Gus Papagiorgio is an associate director of research at Macquarie.
And now to Paul Bagnall at Home Capital's annual general meeting on Thursday in Toronto.
Home Capital Group is facing shareholders at its annual general meeting after the alternative lender gained TSX clearance to sell a near 20% stake of itself to Warren Buffett. BNN's Paul Bagnall is outside the AGM. He joins us now live on location. Paul.
Lots happening with Home Capital Group today, Michael. The annual general meeting has just concluded. The management and board of Home Capital took questions from shareholders for about half an hour, then an additional questions from those of us in the media for another half hour or so. Some of the takeaways, the company saying it is close to announcing the hiring of a new chief executive officer. No names yet, certainly, but we were told a couple of times that the word is soon and that a short list of qualified candidates has been drawn up. The board is confident of stability on the board of directors over the next year at least, and perhaps for the longer term as well. This is a board that is very heavy in crisis management, as you know, and the board is confident, the chair of the board is confident that there'll be board stability, and they are confident as well, management and the board, that Berkshire Hathaway and Warren Buffett are also in for the long haul, despite the lack of popularity that was expressed by some shareholders over the deal, the price that Buffett got on the stock. Let's go topic by topic. Chairperson Brenda April saying that a new chief executive officer will be hired soon, and she's very excited about the short list that was drawn up. She said it was not a short list, but a short list of very qualified candidates. I asked her about the board question. Will members like Claude Lamoureux, who's famed for his governance expertise from his years at the Ontario Teachers' Pension Plan, will he stay for the long term? What about Alan Hibben, who's become the face of the company effectively during this crisis, a director with long experience in crisis management and turnarounds? Here's her answer.
The new directors have been very enthusiastic about assisting and rolled up their sleeves, and I think have been excited about the opportunity to help the company. And so it would be my expectation they will stay on board for a few years.
The Michael, I asked Alan Hibben, the lead director, really, of Home Capital Group, or certainly the most vocal and visible director in the company, is Warren Buffett in for the long haul? And is he in for the long haul if shareholders vote against the second tranche of Buffett's announcement, as they have the right to do? He said that he is confident that Buffett is in for the long haul, much longer than the 4 months that he's required to stay in the stock. The company would still retain the credit line. It would still have Warren Buffett and Berkshire Hathaway as a 20% holder in the stock if later this year shareholders vote no on a subsequent 20% tranche. Michael?
Thank you, Paul. Paul Bagnall, live on location at the annual general meeting for Home Capital in Toronto today.
Okay, folks, we'll go to a break. When we come back, CTV's chief financial commentator, Patty Lovett-Reid, and how safe is your pension? And you are listening to 580 CFRA on this incredible Canada Day weekend.
You're listening to Money Talk on News Talk 580 CFRA.
Patty Lovett-Reid joins us now. She's going to tackle the question, how safe is your pension? That's a pretty important question for people near retirement.
It is, absolutely. And for those who are in retirement and collecting that pension. And so you've worked hard, you've contributed. And what we do know is that a defined benefit plan is a dying breed. There are not a lot of companies because they're so expensive to upkeep and to make sure that they're solvent and that sort of thing. So Mercer comes out with its report, and it's called the Quarterly Solvency Report. And here's the good news. And it's been a while since we've really been able to say, here's good news when it comes to this. The second quarter, you actually see, according to the Mercer Pension Health Index, it's a hypothetical plan, it's actually up. It's at 103% from 102%. So I thought, okay, what does that actually mean? It means that on a typical pension plan that's defined benefit on the year, it's up anywhere from 10 to 15%. Now, there is a big difference between a plan that becomes insolvent and the company goes bankrupt and a plan that may not have been fully funded. Because when you go through recessionary times and low interest rate periods, it's expensive. They're not getting the return that they need to be fully funded. But the fact is, I think it's still a rallying cry for a lot of people to say, okay, if I have that kind of plan and I'm counting on it in retirement, what's the state of it? So I'll throw it out there, given the market environment.
We certainly hear a lot. We've heard since the financial crisis, lots of companies updating the market on their plans to top up their pension investments after, as you said, low interest rates depress the numbers. What is the fundamental difference, though, to retirees between a defined benefit plan and a defined contribution plan, which are really the norm these days?
Well, the defined contribution plan, you're going to put aside so much money, the company's going to put aside so much money, but your ultimate payment in retirement is going to be dictated by the type of return and how you've managed that money. And so it can be very good or it could be compromised depending on how big a bet you decide to take or not take on the plan, slow and steady. They say a typical balanced pension plan, according to the defined benefit, would have yielded in the second quarter 3.6%. Now, I know a lot of people who are planning for retirement down the road, and they may want to gamble. They may want to put more into the equity market. I do think when you look at the Canada pension plan or other pension plans, if you're setting up your own, you don't have the luxury of the defined benefit plan, that's a good place to start. And often it can be 60-40 or skewed a little differently. Your thoughts?
Well, I think this is a really important topic right now because we are heading into a higher interest rate environment, and most economists spend their time talking about how this is going to cool the economy, but there are benefits to a higher interest rate environment, particularly for savers and for pensioners. So we could actually see a little bit of an improvement in that picture, bond yields moving higher, making it a little bit easier for those who are on a fixed income moving forward. Still base bottom interest rates relative to the old time, but certainly an improvement at the margin. So something we should be watching as a benefit to higher interest rates at the same time as some of the disadvantages.
Yeah, and I tend to agree with you here, and I do think that as interest rates start to go higher, when I look at the performance, most equity markets were up in the second quarter, but the Canadian market, and we did see bond yields tick a little higher, and that helped out the pension plans as well. So you put it all together, it's not a bad scenario, but I think if you're an individual, when it comes to your retirement streams of income, when you're actually retired, no one's going to care more about it than you. And so I do think you owe it to yourself. Think Nortel. I mean, there are pensioners just now getting paid from that spectacular bankruptcy. So you need to understand the state of your pension plan, what it means. Don't be panicked if it's underfunded, but you want to stay on top of it. You just can't abdicate and say, okay, the company will be there for me, because they may not.
Is there any concern, Francis, about the stability of pensions from a macro point of view, in terms of what those pensions mean to the health of the Canadian economy?
Well, we're always looking at demographics and how the older generations are going to continue to sustain the economy. So that probably is something that we're watching very, very closely. But I wouldn't say in anyone's 3 to 5 year forecast that pensions itself is changing anybody's perspective on where the economy will be moving forward. Demographics, however, lower income, fixed income, those are trends that we're seeing across all developed markets, and probably one of the reasons why we're seeing a slower potential GDP or GDP numbers across most major economies.
Francis Donald and Patty Lovett-Reid on pensions. You can check out Patty's full blog, by the way, on our website. That's bnn.ca.
We conclude today's show with Dale Jackson, and he takes a look at why Canada is a great place for retirement savers.
You don't need to go far to find something to celebrate this Canada Day weekend. Dale Jackson's here to look at a few uniquely Canadian financial opportunities that can help people realize their own Canadian dreams. Inspire us, Mr. Jackson.
Well, there is no Canadian dream. It's everybody's dreams, but there is something consistent with any Canadians reaching their dream. There's a couple things you want. You want financial security, and you want some prosperity, and you want the opportunity to do that. I mean, in democracies, they don't work unless there's social mobility, and social mobility doesn't take place unless you can come up from the bottom, or you can come up from wherever you are and work your way to the top. And Canada provides those things. Just wanted to pick, 4 basic things for people just to kind of look at, feel good about on this Canada Day weekend. First is what could be more Canadian than your registered retirement savings plan. Something available to Canadians. You get an immediate tax break when you contribute to it. Could grow tax-free until you retire, and our government allows us to borrow up to, in some cases, up to $10,000 for our $25,000 to borrow to buy a home, your first home, or $20,000 if you want to go back to school. 2009, we got the tax-free savings account. Gains are never taxed in a tax-free savings account. You're allowed to purchase a home, make it an investment, and you never have to pay on it. Something else like a TFSA is your capital gains exemption on your principal residence. So in addition to a TFSA, which you invest in and the gains are never taxed, you've got your house too, which is your principal residence. And one thing that we've seen, a lot of people may be proud to be Canadians, is Canadian Deposit Insurance Corporation. A lot of people didn't know what that was until Home Capital came along. If you save your money, it is backed ultimately in any bank or financial institution that is registered by a Crown corporation called the CDIC, and insure your savings up to $10,000. And finally, something that is very topical is healthcare. That's something from a financial point of view that it's really nice not to have to worry about. Just something I pulled from the U.S., which is going through some troubling times right now in healthcare. According to HealthView Services, lifetime retirement healthcare premiums, that's the deductibles and other fees not covered by Medicaid, for an average 65-year-old couple retiring this year over their lifetimes, they would have to pay over $400,000 in just for healthcare, something that you have to budget and something that would normally not be in your savings and allowed to be invested and allowed to grow and accumulate. And another thing about that is the political uncertainty. It's really good to live in a country where you don't have to worry about these things coming up. These things coming up is where you have to get dinged by healthcare expenses. You find you've saved so much for retirement, and in many cases in the States, you get whacked by a certain healthcare issue. And in the States, they're divided on. In Canada, every single major party supports universal.
Drake likes to say he started at the bottom, but he started with the safety net and worked his way.
I wonder how much he put in his RSP.
He certainly has the wiggle room. All right, thank you very much.
Happy Canada Day, Dale.
Yeah, Happy Canada Day. Head over to bnn.ca to read Dale's very patriotic blog on bnn.ca.
Well, folks, that's it for Money Talk. Thank you so much for joining us this afternoon. Have fun, travel safely, and enjoy the rest of the weekend. I'm John Budden, and you are listening to 580 CFRA.